Hello and welcome to the Capital Grounds podcast. I'm your co-host, Nick Miller. I've got my other co-host, Joe Fisher here. Good morning, Joe. How are you today?
Morning, Nick. Doing good, man. How's about yourself?
Hey, it's going to be a warm day here in Kansas, but that's all right. That's all right. For our viewers or listeners that don't know, we're with SITG Capital. We're a real
hmm
estate investment firm currently based out of Texas. We've got properties in Houston, Dallas, Austin. We're looking to expand in Texas, across the Sun Belt, up the I-35 corridor. We view the current environment as go time, if you will. So if you haven't checked out our website, check it out, www.sitgcapital.com. We're
hmm
bringing you real estate news this morning, real estate topics, and my favorite part, a little bit of coffee. So, as we dig into it, Joe, tell me, what have you been up to lately? What do you see in the news?
Yeah, so there's a lot happening out there. I pulled a couple of interesting articles. Everybody's hearing about commercial real estate debt, those types of things. So I pulled a recent article from the Dallas Business Journal. There's more than 1 trillion in CRE debt maturities that are coming down the pipeline. And it highlighted what cities have the most exposure. So out of those, you would expect, the biggest markets probably have the most exposure. So of course, New York, LA is at the top of that, Miami, San Francisco, Chicago, all of those. DFW, kind of, it's going to be about, sixth in the country, sixth, seventh range. And then Houston, Austin, much further down on that list. But that's just the highest loan balance for CMBS that's set to mature December 31st of 2024. So there's a little bit of time for that to happen, right? But that's really the highest loan value. New York has the most with 149 CMBS loans that are facing distress right now. So when you look at the distress numbers, the cities fall a little bit different. New York's still going to be at the top. However, Chicago jumps up to number two, and Houston, not far up on the previous one. When you look at the stress, Houston jumps up quite a bit and Dallas falls quite a bit. So interesting how those dynamics play out. You've got the volume in there, but then you also have what's happening in the distress market, how many loans that, are basically underwater at this point, and in what markets it's the worst. So we're looking at that as, potential opportunity coming down the pipeline. Um, Again, a lot of these loans won't mature for a little bit longer. So our prediction was, we got to be ready over the next year or so. And that still kind of holds true to what we're looking at here. Unless rates make a drastic change, Nick, to the downside, I don't think that this distress is going to fix itself in that time frame.
Yeah, fair enough. And to confirm, I think you mentioned this, that's December of 2024, correct?
Yeah, they're going out that basically they're looking at loans set to mature by December 31st of 2024, which doesn't mean they'll all, mature on that date. They're just saying by that date. So, we're really looking at probably the next 6 months or so, we're going to start seeing more and more. And then, within 2024, we think there's going to be quite a bit of this happening.
Yeah, that's a lot. There's a lot going on in some of these places. I'm looking at the
hmm
the same information you are, and gosh, I got to tell you, the New York, I don't know, New York City metro area, Jersey City, the tri-state area, there's a
hmm
massive, massive, almost 40 billion when the next highest is what, just under 20. That's a
Yeah, LA.
significant, yeah,
hmm
that's a massive chunk, a massive chunk. And then when we look at the amount of distress, you know, uh, looks like New York's at just under 2.6, so we'll say
hmm
2.5 and a half billion. Uh,
Right.
for those that are interested in real estate, recognize that the current distress in that overall group, is a very minor number, right? You look at 2.5, that's
Right.
probably what, 8% of the 40 billion.
Right.
Um,
Yeah.
but
Right.
but still, we'll look to see what happens over the next 2 years. I hear the joke survive to 25 as kind
hmm
of the the mantra for a lot of these firms. But Joe, I
Yeah,
think we're all in, we're all on board. This is the time to take some action and get some of those great deals. And we've talked about this probably in almost every episode because it is so important.
it is.
This
Yeah,
goes to show the value of having a strong operator, right? Make
it
sure that
does.
you're in good shape, and you gotta when you're forecasting, especially when you're forecasting your debt, we like to be super, super conservative because you
We
never know
do.
what's going to happen, right?
Yeah, it will. I mean, we'll illustrate in that and what we're talking about today. But
Mhm.
from to your point, Nick, I think that it's we both came up working in financial services, right? Working with primarily the equities markets, but bonds played a role in that too, right? And we believe for commercial real estate, this is the 2008 financial crisis moment for commercial real estate. So for us, this is when you invest as much as you can without putting yourself at too much risk. And if we would have had hindsight back then, or if Nick, if we would have been working in the industry back then, we might have gave that advice. I don't know. When it came to the stock market back then. So I think it's a similar situation. It's gonna play out slower because it is real estate, and real estate plays out slower than the stock market. So you just got to remember that as and be patient as you go through this time.
Be patient. I think
Yeah.
that's great advice. Great advice. And it's interesting to me just on a sociological level, you know, the socioeconomic impact that we've
Mhm.
seen COVID have on our society. And I don't track. There's enough going on in our market. I don't track other markets, but I'll be interested to see how the entire world is affected, not just in real
Yeah.
estate as a whole, from everything that's gone on the last 3.5 years at this point.
Right. Yeah. Major shifts have taken place, and I think will continue to be there, and something that we have to adjust for over time. There's a lot of office space that's out of date and really not worth updating to be additional office space, just as an example in real estate. And that costs a lot of money to do. You really got to find the right property. So, that's a tough one. Uh, Nick, I had one more article I wanted to highlight, though. There was one in the Dallas Morning News recently, and basically the gist of that is for the first time Texas, Florida, Georgia, the Carolinas, and Tennessee are contributing more to the national GDP than the Northeast. So,
Wow.
first time in history that's flipped. So, it's just kind of showing us what the longer term trends have told us for a while, that, there's really been more capital investment in those states than there has been in more expensive states like the Northeast. And, California had its heyday for a long time and still is a juggernaut, right? But really, these
Certainly.
places are catching up, and these places are growing in population. At the same time, they have good, education systems, being able to produce great talent. So there's a lot happening that's driving those trends. But I thought that was an interesting point, kind of just the overall point there, as far as how that looks, and how first time in our nation's history something has happened.
Being in the heartland, in the heart of the Midwest, in the heart of the
Hmm.
country, I'm wondering, I often have conversations with peers, colleagues, and friends that make me wonder what the Midwest, the Oklahoma, Kansas, Nebraska, Missouri, Iowa, what are these
Yeah.
states doing? I mean, Minnesota has the Twin Cities, which is, we recently moved from, and
Right.
there's a lot of great business going on there. But, I think they're fighting to continue growing from a business perspective. But I'll be curious, what are the rest of the Dakotas? I mean, basically Oklahoma North, what are these states going to do to continue to try and add value long term? And will we see a period where they, where maybe they can contribute more than they are now? but that's me looking out my back door. So,
Yeah, no,
uh,
of course. I mean, trends do change, but they change slowly. And this has been a trend for a while. And we don't, most places that do surveys. I mean, even the government surveys, all this trend to change anytime soon. But to your point, I think there's a lot of factors that go into driving that. There's um, you know, great talent pools. They're desirable places to live for the most part. Uh, you've got a lot of things working in your favor in those states. They've historically been much cheaper than a lot of states. To your point, though, the Midwest has as well. Um, but I think there's people are paying more attention to, oh, do I have access to a beach? Do I have access to hiking? Do I have access to things like that? And that's
sure.
Midwest can't compete with a Florida, the Carolinas, a Tennessee, a Georgia, or even a Texas has a lot of those things. So I think quality of life plays into it, and until the cost of living in the Midwest just makes so much more sense than anything else. I think the trend won't change.
Yeah, yeah, I'm with you. I'm with you. We'll see what it looks like in 50 or
Yeah,
60 years if we're still around. But
yeah, yeah. But Nick, we didn't talk about our coffee yet.
we didn't.
Tell
We
me
kind
what's
of
good.
skipped over that. I'll tell you, I've got a new mug here. Got a new
Yeah,
mug. So, we recently went on a family vacation to Wyoming. We
nice.
stayed in the cabin for about a week and
Hmm.
just had a great time. So this is my mug from the Wyoming trip. And
That's
uh,
awesome.
I've got a local breakfast blend in
Mm,
here from a local coffee roastery. And I'll tell you, I'll kind of keep it a little under wraps because I don't want to, I don't want to, it's not my favorite. It's not my favorite. It's a ho hum
that's fair.
blend. Yeah. So I don't want to do anybody disservice.
Well,
Uh,
I don't mind
yeah, go
saying
for
I
it.
think I've got a coffee shop just down the road from me and down the road from where we're developing. And I think that's the best coffee in Dallas. It's Full City Rooster. Great job roasting. They got some unique offerings at the shop too. There's a Topo Chico cold brew, which full disclosure, I haven't tried, but if you know anything about Texas, that's a popular thing down here. Get your Topo Chico. So he created a Topo Chico cold brew, which I thought was really interesting. But yeah, just he started out kind of in his house roasting and just selling it out of his house, and then he got a shop, and it's only grown from there. I mean, I go there on the weekends,
Wow.
and everybody from the neighborhood's there because it's the best cup of coffee you're gonna get. So if you're in the Dallas
Wow.
area, come check it out. Full City Rooster, great coffee.
Is that what's in your cup this morning? Are you past the cup of coffee?
I already finished my cup of coffee, so no, but it's not. But it's right down the street from me, so it's easy for me to go grab a bag and get it going in the morning. But I still got some leftover coffee I got to get through first.
Ah, fair enough. I'm still plugging away at this stuff. So
Yeah,
um, anyway, I'll tell you, I really this mug is a little big, but I really like the potbelly shape of mugs. I have
yeah,
a
yeah,
theory, and I don't know if there's any value in it, right? But I believe that the potbelly, the tapering here in the middle keeps the lower half, the bulk warmer, and this doesn't taper too much, but the bottom half stays warmer, and then the
right.
top half gets more exposure to the air, so the actual drinkable portion maybe cools off a little bit while the rest of it can stay a little warmer. That's what I'd like to think anyway. I don't know. I don't know if
Well,
there's any science
we'll
behind
bring on a
that.
scientist next time and have them give their 2 cents on if that's
There you
true or
go.
not.
There you go. Hey, that could be fun to bring in a local roaster. I wonder if we know any real estate oriented roasters, but
Oh
that's
yeah,
probably
that's a good idea. We could absolutely do that. That would be a good time.
that'd probably be too much of a blend of both worlds. But anyway. Well, Joe, let's so this morning we're going to do something
Yeah,
different than we've done before. We're going to talk
right.
about one of our recent projects that we've completed, do a little bit of a case study. Um,
Yeah.
yeah, so for I know you manage this project.
Right.
Let's talk about Fisher Street, not named after you, correct?
Correct. Yeah. I mean, unfortunately, I've yet to have a street actually named after me. But it's
Well,
it was a good project. So the format that I think we're gonna do today is Nick's kind of got the information in front of him. He's gonna go through, ask me questions about it, and we're just gonna take you guys through the timeline, what we thought the numbers would be, what the numbers ended up being, and just kind of illustrate to you some of the high level points and again what we thought would happen and what actually happened.
yeah. So, first off, talk to me about
Mhm.
the location itself.
Yeah, the location is in Houston. It's not far from the Heights in Houston, which is a really great area. We actually have another project that we're doing over there. It's probably it's definitely one of the most desirable areas in Houston, but it might be the most desirable. So older neighborhood, however, you've got a lot of newer construction there just because values have gone up so much. Very walkable. It's called the Heights because it sits higher than the majority of Houston. Doesn't have really flooding issues over there, which if you guys know much about Houston, that's a
Oof.
big deal.
Yeah, it is.
So this was just outside of that neighborhood. Um, so you had that kind of appeal where you were close to it, but the price was a lot better than being right there in it. So we were able to kind of build these mid-tier homes that we felt the market really supported and really needed. And we understood at the time when we started this that rates would probably go up. We didn't know when, we didn't know how much, we didn't know how quickly, any of those things, right? We thought they would go up. So being mid-tier for us made sense because you got people coming from, maybe their first home and they want to upgrade, or maybe people realizing, hey, I can't afford what I thought I could. I need to go down a little bit because rates went up. So we liked kind of being in that middle catch-all with it.
Yeah, and I'll tell you, I've got it pulled up here on Google Maps, although it's a really poor it's a really poor look at it. Half of it's blurred out for some reason on this one particular page. But yeah, I'll tell you, they look really, really clean, really well designed. And this has been, when we stopped by it last time I was visiting, it's one of those places that I really, really enjoy of our projects. I think it's certainly someplace I would live, and
Yeah, same.
I think it's in an area that's growing,
Hmm.
and the Heights is a fun little area to hang out in. So I'll be curious to see how it grows down the road and how the area continues to develop. But were there any particular things that really drew you
Hmm.
to this? Was it just the numbers,
Yeah.
or are there any other connections?
Well, so for this one, we were bringing on a new group of investors to fund this one. They were looking for a project, and we brought this one to them because it was shovel ready, meaning that the uh, the GC had already gotten the permits, all that stuff. So it was ready to go. It just needed funding, so we didn't have to
Sure.
wait. Now Houston is a unique market because they don't have zoning and typically it's much easier to get through the permit process there. So, it did still save a couple of months though. Probably 3 to 5 months, depending on design time. So that was the main draw to it because with newer investors, we really wanted them to be able to see visual progress very quickly, so they could trust the process and, speed up the exit timeline for them in any way we could.
Yeah, that makes sense. That makes sense. And was this land, you mentioned it was
Mhm.
shovel ready. Talk to me
Yeah.
about the I'm going to call it the pre-work. Was this land that we'd
Mhm.
previously acquired, or was this land that somebody else had done the permitting and created the base, the shovel ready situation for you?
Yeah, so through our joint venture with our general contractor, we acquired this land and got through everything before bringing on investors. And then, we put some additional money in alongside them. to invest into this project. But it was identified by our main partner there in Houston. He's our main GC for development, and it was identified by him, and we just kind of went through the process with him.
Sure, sure. And for our viewers and listeners, I'm asking questions from your perspective.
Mhm.
So, if I miss something, feel free to give us a call, leave a comment. If you like these case study ideas, we'll continue to do more as projects get completed. But um, I'm going to go ahead and share the pro forma so that we can talk about that.
Mhm.
All right. So we had an initial, the initial lot price, 950.
Yep.
Construction costs projected was just over 3.3 million.
Mhm.
Actual numbers were a bit more than that, about 7% more, so 3.55 million.
Mhm.
So, a couple hundred, 200 and we'll say 240,000 more than projected.
Right.
What sort of issues during the construction process did we run into, and what, were there
Yeah.
particular items that we had to deal with to drive those costs higher?
I mean, there was a lot. So if anybody's done any development basically since COVID, you know that there's been a lot of issues. Supply chain issues are still very prevalent in the construction industry. And back in 2021, it was worse than it is now, I would say. So there were a lot of things that, hey, this ended up being a lot more than we expected. Or I can give you a specific example. I mean, we were going to have to wait a couple of months for our trusses, and that just was going to blow up the timeline. So we did everything we could to find a workaround. We ended up finding an engineer that would certify us building the truss, each truss on site. So
Wow.
that cost us a little bit more to go that route, but it saved us probably 2 or 3 months of waiting to get the trusses. So, we ended up saving money in the long run, but again, that's going to reflect in the construction costs because it did cost more to go that route initially. But that's a pretty good example of kind of a pivot in the moment, just based on, supply chain issues.
Good for you. And I want to commend you on thinking outside of the box, right? Trying to find other solutions uh, than just taking it the way it came, because I think that part of building the success is continuing to find those solutions to the problems rather than accepting
Yeah.
what's been handed to you, right?
Oh, definitely. And you got to come into it with that mindset.
Certainly, certainly. When we look at the soft cost
Hmm.
projections, we projected 29.7, came in 50% more than that at,
Hmm.
just under 45,000. Granted, we're talking about maybe 15,000 difference, so it's, not a significant difference.
No,
Um,
but still a difference. And most of that is going to be, look, there's things you can't predict with governments, with city governments, even a really historically easy one to work with like Houston. There may be something that, they come out to inspect and they decide, hey, we really need this redesigned. Um, we've had, I believe in this case, it was the sidewalk access points that we needed to redesign was one of the things. So just you have to be prepared for that. As much planning as you do up front, there's always going to be something that comes back, and they're going to say, "Hey, we missed this, or we need to change this, or whatever it may be." You're kind of at the mercy of local governments when it comes to some of that stuff.
Certainly, certainly. And oof, thankfully it was in Houston. Can you imagine what it might have been like in some of these other cities we work in?
Yeah, definitely. And that's one thing that's really tough about timeline, right? So we really try hard to set proper expectations, but sometimes the timeline can get blown up and it has nothing to do with how hard you've worked on it or anything that you've done. It really has to do with the city. I mean, I'll give you an example in Dallas. Dallas had a data breach at the city, right? And so they've been down for a couple of weeks, and that puts all permits on hold, and there is nothing you can do about that. So, you know, it's tough. Thankfully, again, Houston has been pretty good to us from that perspective. So we haven't had a ton of issues.
Well, I won't dig into, every line item here,
Mhm,
but I want to highlight one that I think is impressive. And, I want to frame this question around so when we initiated this project,
mhm.
when did we, when did we break ground, so that we can get a good perspective?
Yeah, so I mean, we started all the underground work, which that would have been, you know, like the pipes that connect to the city sewer system and that type of stuff. That would have been started in February of 2021, I believe.
February of 2021. So right around the time that rates were starting to increase, right?
Yeah.
Yeah, and the financing cost we projected at 203,000 and change. And
hmm
this is where, yeah, I think this is an excellent example of the conservative forecasting we do. Uh, the projected financing cost was 203. Actual financing cost was just under 166. So,
Right.
saved about 40,000 and change,
hmm
80% less than what we projected. And really, that's our long-term goal when we look at these projects. We want to try and build in cushion where we can to uh, be as accurate as we can in what future numbers may look like, but also hopefully have better performance than we initially project. Um, so
Exactly.
so great job. I think that deserves kudos there. There were some other areas. Incentives were higher than we expected.
hmm
Um, when we look at the total cost was projected at 4.93 million. Our
hmm
actual was 5.16. So we
hmm
were just under 5% more than our projections. And again,
Right.
that's all of the forecasting was done, we'll say late 2020, early 2021.
Yep.
And, when you're projecting that'd be 2 years out from completion,
hmm
having a sub 5%, difference there, I think is pretty darn fantastic in a rising rate
Yeah.
environment where over that time period, construction costs skyrocketed, financing costs skyrocketed, uh, you know, everybody was thrown into more turmoil from an economic perspective. So 4.78%, that was the difference. That's pretty fantastic.
Right. I think so. And I mean, you know, the goal would be for it to be less, you know, for it to go the other way, right? But you can't predict the future. You do
Certainly
your
not.
best to do it in do it conservatively, right? But to your point, Nick, I mean that's been one of the toughest years in the last, you know, probably almost 2 decades for
Yeah,
doing development.
yeah.
With rates going up, with costs and all materials going up, all of that. So that's exactly why we take a conservative approach when we try to do these numbers, because we are trying to basically predict the future, and you're never going to be right. You're never going to get the number exactly right, because you know there's too many factors that are outside of your control. But you hope that you can get close. Because remember, when we go and we do these projects, we need to have all this stuff up front before we get lending, right? So we need to have all of this stuff projected out, and the bank has to certify it, say, yeah, we think you're pretty much in line there. So we can't just you know predict those numbers after the fact. We can't go in and say, "Hey, this is the rate we actually got." So this is what it is, right? We got to go ahead of time and do our best to predict what that's going to be.
And, when we're looking to bring in new investors, when we're looking to invest
hmm
ourselves, whether on a personal level or from the firm perspective, I mean, we have to use our best guess to even decide to take on a project, before
Right.
we even reach out to anybody when we're crunching the numbers and doing the due diligence. That's a make or break situation. So
Yep.
in what, I think what you could argue would be a worst case scenario, we came in less than 5% over our projections. I think we hit the nail on the head personally. That's my opinion.
Yeah, I agree.
Uh,
And we'll get to kind of the end result there in a minute, I'm sure, Nick, but yeah, you can see that really did not affect our end result.
it didn't. It didn't, and thankfully, the revenue from sales was, almost 6% higher than what we projected. So that worked out in
Right.
our favor. And at the end of the day, our projected profit ended up being about 14% more than what we initially expected. So at the end, all in,
Mhm.
when everything is said and done, when we come in and our profit is greater than what we project, that's the ideal scenario. We want to overperform, set expectations lower than what we think the actual will be, and make sure that those are still good performance numbers. And then we want to come in
Yep.
and knock it out of the park.
Yeah. Yeah. So we set the expectation going in that we would be, around, we were hoping, we were targeting 25, 26% to be able to give for our investors, right? So we ended up doing just over 30% on this one, almost 31% if you round up. So we performed quite a bit better. And I don't know if you guys remember everything that was going on during this time, but the stock market was going down. I think, Nick, 2022, we were down, what, 20% in the S&P, something like that, right?
Yeah.
So
Yep.
during a really difficult time to make money, we made our investors more than 30% on this particular project.
And that's over the course of what, 2.5 years? Probably
Um,
closer to, yeah,
it's
go
close.
for it.
Yeah. Yeah. So I don't have the timeline in front of me. You might, Nick, but
I do right
um,
here.
yeah. So if you want to share what that is. So to give a number example though, if you would have invested $50,000 in this project, you would have came out with more than 65,000 at the end of it. Um, so a relatively small investment from a real estate perspective gives you a pretty good yield in this scenario.
Yeah, so I've got the construction timeline here up on the screen.
Mhm.
But for those listening and not viewing, site work started in December of 2021. So you're looking right at about 2.5 years. And I think, we just wrapped things up, what, about a month ago? Um,
December,
so,
let's see, so December 2021, and then we would have had all the 2022. No, it's less than that,
mhm.
Nick. If it was December of 2021,
Oh, you're right. You're right. We're looking at like a year and a half.
a year and a half, yeah, about a year and a half, a little over that, which is what we were shooting for. And sales became much more difficult when rates went up, right? So that was definitely a factor, but thankfully the prices didn't fall for us. So yeah, this project ended up taking just over, uh, yeah, right around a year and a half, really.
Yeah, that's fantastic. So 30, we'll round 30% over a year and a half. That's a pretty darn good deal. A pretty darn good deal for sure.
Yeah, I mean that's gonna be hard to beat. You're not gonna find too many things that are gonna do that that give you that type of return over a year and a half. And again, that's part of the reason that we chose this project is because we knew the timeline would be a bit shorter, and so we were able to perform and really get things taken care of. And I think I said February 21 earlier. I meant February 22
Mm.
was when we were really getting past the initial site work, as I think you asked
Y-
that question earlier, Nick.
Yeah, yeah. Development started 222. And then, we completed
Hmm.
everything late last year,
Yep.
uh, with sales, going on over the last, the few, I would say first quarter of this year, first quarter, a couple
Yeah.
of months into Q2, but that's still not bad at all. Um, so when we look at the value that projects like this bring, uh, you know, And remind our viewers, if this is
Mhm.
something that interests you, we've got other projects that are very similar to this on the docket. What is the minimum investment that we typically take for projects of this nature? And obviously it
Yes,
depends, but
right. So I use the 50,000 mark. That's the minimum investment. What we've kind of done though is recently these projects that are smaller in scale, these townhomes or these single family homes, things like that. We're doing the majority of that through our growth fund. And the reason we're doing that is that allows us to pool and do several of these and, get you exposure to more than one project. Because while this is a good project, there could be one where, there's factors out of our control, weather factors, whatever it may be. I mean, there's a lot of things that happen here that make the project not as profitable as this. So our goal is to average that out, get you guys at least, the goal is a 20% return. That's the goal. So if we can outperform that, we would love to. We'd love to give everybody as much as possible back. So that's kind of how we're doing it now. 50 would be the minimum that you can do. But again, in that illustration, a year and a half, your 50 would have gone to, I don't know the exact number, Nick, you can calculate it if you want, but 60, a little over 65,000 in a year and a half.
and what I love about this is that we are bringing value to our investors. We're bringing value
Mhm.
to which investors include ourselves, right? Include the firm,
Yep.
SITG, skin in the game. So we're adding value to our investors. We're adding value to local communities, the communities that these are in, and we're helping to alleviate the massive housing shortage across the
Mhm.
board, all while giving people more jobs. I mean, there are a lot of great things that come out of this, right? And honestly, I think this is a great example of a win-win-win scenario.
Yeah. No, I would agree. And one thing we didn't really mention, Nick, I mean, we mentioned it casually, was we invested in this
Sure.
project as well, as we do with all of our projects. So to give you an idea, Nick, do you have what the actual investment was in the pro forma? Do you have that in front of you?
Yeah, hang on here.
Yeah, if you want to pull that up. So we as a firm did 100,000 into this property. So I believe that would have been a good chunk of that. I just didn't have the exact number in front of me as far as what that is. But our goal is to do anywhere between 10 to 20% of any given project we're doing that is funded personally by us, because we believe there's a lot of value to having our own money in the deal. If we perform better, that means everybody else performs better, right? So our goal is to grow our money alongside of our investors, not take from the growth of our investors. So we really believe in that, and we really think that that's something that sets us apart from almost anybody else in the industry.
Yeah, so it looks like total investment was about 1.2 million. Total cost was just under 5.2 million.
Yeah,
And then
so if we include what we did with the land before and all of that stuff, we would have been, I believe, just over 10% of this particular project.
that's generally where we like to go, depending on the
Yeah, 10,
investment
10 to
group.
20 is where we want to land at all times. I mean, there are, full disclosure, there are projects that we have just funded on our own. So there are
Sure.
projects where we're 100% or maybe we're 50% and there's one other investor. Things like that have come up. But I would say generally speaking, we're looking at the 10 to 20% range as far as what we're going to put of our own personal money in it.
Sure. Because we believe in diversification, just like we preach to our clients, right?
Yep, exactly. Yeah.
Yeah. So, we covered some of the hiccups. We've broken down some of the final
hmm
numbers. I would love to hear things that went well. Were there any items that went better than
hmm
expected? And we talked about some of them already, but
Yeah, I mean, we kind of talked about that. Some of the hiccups we turned into some things that ended up, going well. I would say the timeline overall was really what we projected in the first place. We talked a little bit about the rate, right? We went under So we did the rate higher in our projections than what it actually
Right.
ended up being. So those are things that went really well. I will say this went well primarily because of the great partnership we have with our general contractor. He did a fantastic job managing the construction timeline. And there's always going to be hiccups along the way here and there, but he's got the experience to get around them. So I'm gonna say, the credit really does go to him and his team. And we just have done a good job of, putting the right people around to be able to execute on these projects and be able to make them a success.
Fair enough. Fair enough. Well, for our viewers, listeners, I will include links to some of these items if you'd like to review them for yourself. You can check it out if you want to drive by the units. They're sold now, so you're driving by people's homes. But
Yeah.
they're at 950 Fisher Street, 948 Fisher Street in
Hmm.
Houston, and beautiful, beautiful townhomes. Check them out. Check out our website, www.sitgcapital.com. Joe, I think this was a great case study. I certainly think we should do more of these. I think this is a great
Yeah.
way to, to talk about the pros and cons and help people better understand how we navigate the quirks, the bumps along the way. But any last minute items you feel we should mention that maybe I've missed?
No, I mean, I think you did a good job of, covering it for our listeners and for our viewers. And guys, I think this just illustrates that to me, you don't worry about timing when it comes to investing, right? You worry about getting your money to work. Because if you would have known what was coming down the pipeline back at the end of 21, and you would have known rates were going to skyrocket and costs were going to skyrocket and all of that, you might have sat out on the sideline. You might have sat on the sideline for this one. But clearly, we just showed you the actual end results. That would have been a mistake, and your money would not have made money during that time. So that's what I would take away from this: is any environment with the right partners is going to yield you a return.
And if you perhaps would have stayed invested in the stock market, your portfolio may have been down. I think it's now
Hmm.
recovered a bit,
Right.
but
Yeah. Yeah.
but it would have been down at the end of the day. That's the important part. That it probably wouldn't have gone up by 30%. Based on this
It
particular
would not.
project. So
Yeah, it would not. I can tell you for a fact. So,
yeah. Well, viewers, listeners, again, sitgcapital.com. If you've got questions, thoughts, give us a call. Would love to hear from you. But in the meantime, Joe, I appreciate your time this morning. We'll
thanks,
look to
Nick.
talk again next week,
Let's do
and
it.
we'll see what the week brings us.
Thanks.
All right, take care. Bye bye.